Half of the US lack financial literacy, and this is why financial literacy is so important, especially to new moms and moms in general. Hi, I'm Gabby, and I started this YouTube channel back when I was on maternity leave, and I wanted to create a space for new moms like me to find different ways to pay off their debt and find financial independence as I'm doing it myself. So at the end of this video, you're going to learn everything you need to know about financial literacy and why it's so important. I just want to add a disclaimer that I am not a financial advisor. I'm really just a mom trying to get out of debt and find financial freedom and help other moms to do the same. Once you have the financial literacy, you're going to be able to make better, more knowledgeable financial decisions for yourself and for your family. You're going to make better decisions of budgeting, saving, investing, and spending. And obviously, that's going to have a huge impact in your future and your children's future. Also, it's so important for women and moms specifically to have financial literacy to address existing inequalities. On average, women are less likely to have financial literacy than men do, and that leads to overspending, high credit card debt, inadequate emergency funds, and insufficient savings. And this is specifically true for single moms in the US because they tend to have less financial security compared to other family structures. And to add to that, Black and Hispanic single mothers tend to have lower household incomes and are more vulnerable to poverty. And they are the ones that would benefit the most from financial literacy, but oftentimes they're the ones that lack financial literacy altogether. Okay, so now that we know why financial literacy is so important, especially for moms, let's get to it and let's start learning all that we need to learn about financial literacy. Okay, so first things first, budgeting. Budgeting is so important, and you need to understand where your money is coming from and where it's going, especially where it's going. So you need to clearly know how much you're spending on your needs, wants, and everything in between. And once you have a strong understanding of that, you can make better plans to save, invest, and pay off debt. And you can clearly get access to all the information just by checking your bank accounts, your bank statements, your credit card statements. But a lot of time people don't do that because they're too scared to even look at their bank statements. They don't even want to know how bad things are. And I'm here to tell you that you have the power to stay strong, open a bank statement, look at what you're spending, and make changes off of that. It's a lot easier that you make yourself believe. Okay, so there's also something called the 50-30-20 rule. So that means that 50% of your income should go to your needs, which includes groceries, rent or mortgage, utilities, medications that you need, like things that you need to survive and be a human being in society. Now, 30% of your income is going to go to your wants. So that's eating out, going to the movies, ordering from Uber Eats, even having a Netflix account, Amazon Prime, like things that are convenient, they also fall into that wants category. And then finally, 20% of your income is going to go towards your savings, and that includes your emergency fund. Okay, so now let's talk about saving and investing. So, saving and having an emergency fund for unexpected expenses and investing to make your money grow for you and work for you, it's so important. And I don't think people fully understand that we actually have so many different platforms available for us to help us with that. And it could be a lot easier than you think. Now, let's talk about savings first. So, it is recommended to have at least 3 months worth of income in your savings account for emergency funds. Um, but I like to say that if you have kids, you should probably have a little bit more than that. So, you should have 6 months worth of income for your emergency funds. So, let's say you spend $5,000 a month on things is that you need to have 5,000 times six, $30,000 on your savings for emergency funds. I know that sounds crazy and it may sound unrealistic for you, but it actually is very realistic and very attainable if you have the right mindset. And I made another video about how mindset can impact your financial success. And if you want to watch that one, the link is in the description of this video. Speaking of savings, I don't know if you've heard, you probably have, but if you haven't, there's something called high yield savings, and that's a savings account that's fully online. So you're not going to have a card, you're not going to be able to cash money from an ATM machine. It's all online, but your APY percentage is a lot higher than your average bank account. So right now, the average APY for high yield savings is around 4%, with some banks even going up to 5%. And your regular savings account, the APY for that is only 0.38%. That's a huge difference. So let's say you have $5,000 in your high yield savings account. So with that 5% APY, you will have made $250 that year. And if you keep that money in your regular savings, you're only going to have $19 at the end of the year. You're only going to have made $19 off of that money. So definitely, definitely, definitely open up a high yield savings account, and it's going to help you a lot. Now let's talk about investing. And investing can sound very scary for a lot of people. I know that people think about the risk of investing and the risk of losing money, but I'm here to tell you it doesn't have to be that complicated. You don't have to be a trader to start investing, and I definitely recommend you not to trade if you don't have the knowledge to do it and if you don't have the time to do it. There's easier ways to invest. The easiest, least complicated way to invest that I have found is to use robo advisor services that provide automated investment management. And the one that I use specifically is Fidelity Go. And this is not an ad. I don't have enough subscribers to have ads. This is just the one that I use and I like it. So I started off by putting $1,000 on that account, and now I have automatic transfers from my checkings to that account of $100 every month. And I feel like it definitely helps my money grow. I do have to say though that to have days that you're going to lose money, and you need to not overreact. That's the whole point of investing. You can't overreact. You have to understand that the market is going to go up and down, but eventually it's going to keep increasing. And I've learned that if when you keep investing when the market is down, that's when your money grows the most in the future. And one more thing that I want to add is for Fidelity Go, and I'm sure that other investment platforms do the same. Um, you can choose how risky and how conservative you want to be with your investment. So I like to keep my conservative, and I think that also helps my growth, my steady growth in my investment portfolio. And of course, if your job offers a 401k plan, take advantage of that. That's also investing and it's going to help you retire more comfortably for sure. Now let's talk about credit. So if you live in the US, I'm sure you've heard of credit scores, and that's a three-digit number that ranges from 300 to 850, and it is used to see your ability to pay off debt or to pay back debt. And in the US, everything is around your credit score. So if you don't have a good credit score, you're not going to be able to take out loans as much as other people, and you're going to end up paying a higher interest rate with a lower credit score than if you had a higher credit score. Okay, here are some factors that determine your credit score. Payment history. This is the most important one. So late or missed payments, bankruptcies, collections, all of those things will really, really, really impact your credit score in a very negative way. This is the current amount that you owe out of your available credit. So you want to keep the number below 30%. So let's say if you have a $20,000 credit card, you should only be spending $6,000 off of that. You should never go over that because that could also impact your credit score in a negative way. Length of credit history. So the amount of time that you have a credit card open. The longer, the better. New credit. So this looks at the number of credit accounts you have and the number of credit inquiries you have. So the more you have in this case, the least is going to help you. So let's say you open multiple credit cards, that's going to negatively affect your credit score. And also credit increase. Let's say you want to buy a new car and you go to the dealership and you try to get a car loan. They're going to run your credit score, and every time that they run your credit history is going to negatively impact your credit score. So when you're trying to shop around for a car, don't get to that step until you're sure that's the card that you want. Credit mix. So this looks at the variety of credit accounts that you have. So it could be credit cards, loans, mortgages, and the more variety you have, the better your credit score is going to look like. Okay, so let's talk about your net worth. So your net worth is your overall financial health, and it looks at what you own, your assets, and what you owe, which is your liabilities. And it's calculated by subtracting your liabilities from your assets. So to calculate this, first you have to know your total assets, and that includes your physical cash, the cash that you have in your bank accounts, investments, 401k, Roth IRAs, real estate, vehicles, personal items like gold, diamonds, collectibles, and all of that stuff. And then once you know that, you have to figure out your total liabilities. So that's your car loan, your mortgage, your student loans, and other personal loans, and credit card debt. So let's say your total assets is $300,000 and your total liabilities is $250,000. So your net worth is going to be $50,000. And you might think that $50,000 is a pretty low net worth, but in reality, a lot of people living in the US actually have a negative net worth. And a lot of that has to do with age. Younger people are probably going to have a lower net worth than older people, but it also has to do with the current economy and the system that we live in, right? Loans and debt. So it's important to understand that not every loan is created equally. Some loans are going to have higher interest rates than others, and lenders tend to put higher interest rates on loans that they think are riskier and lower interest rates on loans that they think is less risky. Not all loans are bad. A lot of times we have to take out loans to make more money, like going back to school or going to school in general, buying a house. All those things help you make more money in the long run. But there's also loans that don't help you make more money, like car loans, because the value of cars decrease so fast, and also credit card debt because we don't tend to use our credit cards to purchase things that we can resell at a higher value. So keep that in mind when you're borrowing money from lenders. Protecting assets, and by that I mean insurance. If you have lived long enough, and especially if you have kids, if you're a mom, you know that shit happens, and shit happens all the time, and you need to be protected. So there are two ways that you can protect yourself from financial risk. One way is to lowering your risk yourself, and that's by practicing safe driving, taking care of your health, all of those things that you can control yourself. And another way is to transfer the risk to somebody else. So that's when insurance companies come in. So let's say, God forbid, you are diagnosed with breast cancer. Instead of having to pay for all of that cost yourself, you're going to use their health insurance to pay to help you cover those costs. And if you're a mom, I think you should know at this point that you can't control everything, and life happens and bad things happen all the time. So you should find a balance of lowering your risk yourself by practicing safe driving and taking care of your health, but also transferring that risk to somebody else. And that's with insurance. There are some keywords in the insurance world that are super important for you to understand when picking out the best plan for you and the best coverage. So let's go over those. So first is premiums. That's your regular payment that you make to keep your insurance active. Deductible. That's the amount of money that you pay out of pocket before the insurance kicks in. Coverage. That's the specific risks or situations that the insurance company will pay for. Limit of liability. That's the max that the insurance company will pay for a covered loss. Exclusion. That's specific situations or events that insurance will not cover. Policy period. That's the duration that your policy will provide coverage. Insured. That's the person covered by the insurance company. So that's you. And insurer, that's the insurance company. Understanding taxes. So, knowing how taxes work, knowing your tax bracket, and tax advantage accounts, all of those things can help you make better financial decisions. There are two types of taxes. There is a flat tax, like sales tax, so that the percentage will never change or it takes a very long time to change, and a progressive tax. So that's your income taxes, and it changes based on your income. So if your income increases, you're going to change your tax bracket and you might be charged more taxes. So if you have a W-2 job, taxes can be very simple. But if you are a business owner or a contractor, taxes can be a lot more complicated. So in those cases, I definitely recommend hiring a knowledgeable accountant to do your taxes every year, just to make sure that your taxes are done correctly and the IRS is not on your back after, but also to make sure that you're getting the most value for your money. Retirement. So in the US, there are a few different ways that you can retire, and that could be a combination of all of them. And that includes 401k, investments in general, and Social Security. Now, there are some talks that we're running out of money on Social Security, and maybe by the time that you and I retire, we're not going to be able to use our Social Security payments. So keep that in mind. And if you have a job that offers a 401k, make sure that you start investing on your retirement as soon as possible, because we never know what's going to happen. And save your money, invest, and plan for your retirement as soon as possible. Now, to know the amount of money that you need to retire, first you need to figure out your annual costs for retirement. So that includes housing, healthcare, food, transportation, taxes, all of those stuff that needs to be included in your when you're calculating your total costs. So now that you know your annual dollar amount, you can multiply that number by 25 if you're planning on retiring at 65 years old. If you're planning on retiring earlier, like 55, then you have to multiply the number by 35. Factor in inflation. So currently, the average percentage of inflation in the US is 4%. So make sure that you factor that in for your annual expenses. There's also something called the 4% rule, and that suggests that people who are retired can safely withdraw 4% of their retirement per year, adjusting that amount with inflation, and their savings will last around 30 years. And now I want to finish off by talking about the importance of having multiple sources of income. Having multiple sources of income is so important for financial stability and in your financial health. So that could be Obviously, your main source of income is going to be your full time job, but also you should have investments, you should have side hustles, anything that you can make money aside of your job. It's so important, especially in the economy that we live in today. Everything is so unpredictable, and having different sources of income is only going to protect yourself. And just a fun fact, millionaires have an average of 7 different sources of income. So if you can think of 7 different ways that you can make money, do that. So I hope you like this video, and I hope this video reached someone that actually needs it. I'm here for you. I'm sending you all the positive energy to pay off your debt, to grow your savings, and to build a strong financial future for yourself and your family. And if you like this video, as always, make sure to hit like, share, subscribe, comment, whatever you want to do. And I'll keep posting more about financial tips and mindset and all of that good stuff. Okay, bye.